We are not going to talk about the Super Bowl and potential catalysts for commercials and stocks. No, we're not going to talk about that. We're not going to talk about when this cold snap is going to end under 60 degrees in Florida right now. But you know what we're going to talk about? Rolling crashes. A disaster somewhere every day. Maybe not 1, 2, not 3, maybe 5 stocks and rolls into crypto today. Maybe cover the government shutdown a little bit. Not the biggest news. Tim Quast, 8:35. He's chopping at the bit, folks. It's the beginning of the month, and he's going to talk about some monthly setups. It's a big Monday on Pre-Market Prep. Let's get it started.
The volatility right now is really incredible.
Wow, look at that consolidation on the upper right chart.
You know what we've seen this earnings season? Some of these expected moves get even more violent. This is why I have switched my strategy 10 years ago. And if you're chasing, you're in trouble.
Okay, 100-point range overnight, Michael Feehan. We were talking about that. Woo! We are towards the upper point of the range, way off the low of the day. What do you know? Dow 33 handles, 69.32.75. Buck showing a little strength, up 17 cents, 97.02. TLT flat. USO, we'll talk about it. It's down $5, 74.37. GLD slide continues. Both GLD and SLV are both down 2%. And Bitcoin, you can't hang out as support for so long before you breach support. Real quickly, these charts are brought to you by TradeStation. Born to trade. Chart, analyze, customize, all-in-one platform. Learn more about TradeStation from us. Learn more on your own here in the upcoming year. Let's bring on the talent of the show, Brent Slava.
Woo! Feels good. Hi, Joel. Hey, pre-market.
I mean, I back up talent too. Come on, Dennis. Come on stage.
Dennis felt.
He is, man. Like, I don't know if we should get into it right now. Here, we can wait a few minutes, but you were rocking and rolling the STN room Friday night, and you gave us a lot of good trades there for these closing trade. I think we might as well get into it here. Just talk about it off the hop. I know I'm already going off script here, but Joel kind of set us up for this because
Dennis, I want to Dennis, let me ask Joel about his. Joel's shirt looks very suspicious. That very much looks like a Michigan State S, and I think for the chat's purposes, we need to clear this up. What is that shirt, Joel?
Okay, well, Michigan whooped up State on Saturday. We won't go into that. But you know what? It's a gift. It's a gift from Rob Hood.
What?
Nice.
Yes.
Wow.
He's a swim coach, and I sent him a couple Stock Trader Network caps, and he reciprocated. This is a Springfield High shirt, and he also sent me a cap. And this thing is Under Armour. It's comfortable, long sleeve. It was sent to me in the mail, Dennis. You know how you put stuff in the mail and it goes to somebody?
Yeah.
And this thing is super comfy. His boys have some big meets coming up. So Rob Hood, you better be listening today or else we're going to make you listen again. But man, this thing is comfy and it's warm and just feeling great. So big thank. And you all can send me gifts too. If you all send me a gift, I'm an extra large. You know that. But don't send me like anything like scarlet and gray, right? I can't wear that. Purple, I can't wear that, right? Ohio State, I can't wear Northwestern. I'm a little softer on Indiana now because my niece went there. I do wear a Missouri shirt. So if you guys don't like my clothes, go ahead, send it.
Awesome, Rob Hood. I hope you're listening today. That's a very friendly gesture.
Okay.
Nice.
I just wanted to get that in for Rob Hood. We'll make sure he catches up. Okay, go ahead.
Speaking of gifts, Brentster gave us gifts on Friday night in the STN room because we had some crazy imbalance trades. And I know Prad was in there rocking and rolling. I was in there rocking and rolling. And you never know what's going to gap, but I got to tell you, there was some gappers on the close, and it was merger closing So probably the biggest one was this Fifth Third CMA that was closing the merger, which it has indeed closed. So CMA is off the board. So Joel may not have a chart for you on the closing gap because it's actually off the board. But CMA had over 12 million share sell imbalance, and you were shouting these out. You're like, we've got merger deals closing. There was S&P adds and deletes, so those were moving as well. Some of those stocks were gapping up and down, but the big one there, well, CADE was another one too for a gapper, but it was these mergers that were closing, and we had the CMA FITB merger closing. What happened is the stock had 12 million shares to sell. The stock is trading at $93. On the closing print, it gapped down to 88.67, and then instantaneously was back up over 90, trading 91, 92. I bought a whole pile of stock on the closing print. I know that Brad did too. We were talking about it in the chat saying, look, I'm using LOC orders to get in here and buy this on the close. And I paid for years of STN on that one trade. And then there was multiples because there was CADE that gapped as well, and we got that. So I got over 2 points on CMA. I got over $1 on CADE, and I actually got short Fifth Third too, and I got almost $1 on that one as well. When you just get those in like seconds, those are nice trades. So I want to give you the shout out, Brentster, because you were doing the research, obviously letting us know that these were moving here. You could see there CMA moving on the close. So if you're looking at CMA, it is off the board. They did indeed close the merger, but man, that was some good trades Friday night.
Heck yeah. And I was trying to show where I get some of this info from. This is the SP's website, spglobal.com. They have announcements for when they're going to make changes to their indices, when they're going to do additions and deletions to their indices, the SP 500, the SP 100, the mid cap, the small cap one. And as these companies are going to close, they're going to be getting them out of the index and in the index, and that creates a lot of opportunity for imbalances toward the end of the day.
So okay, I'm going to interrupt you too. So those were great trades. We do see the S&Ps going down here right now. Smoke Tuna saying ASML cutting guidance right now. I do see ASML down 16. I'm digging here and trying to see. It was down already. It's not down much, 1%, but if that is breaking news, let me know here, because I actually don't see the breaking news here. But I do see it trading down. So sorry, maybe that is not breaking news. / Smoke Tuna.
They just
ASML trading down.
Yeah, they just had earnings not too long ago. So
and down 16 for a $1,400 stock is not a crazy move here. So I'm wondering if that is not breaking news. I just saw it in the chat, and I was like, they said, like he was yelling, so shout it out there.
The company
do see ASML.
The company did give guidance when they reported last week, so that would be strange if they gave guidance last week and are already having to be updating it this week.
Yeah, I just saw it down in 16, and then I was like, but then I looked at obviously $1,400 stock, but I just saw it on my screen down 16. So okay, but this brings us into the full conversation where I wanted to go anyway. So maybe ASML isn't, but what we have had happen here over the course, and we'll get to these macro headlines, but I want to talk about the theme of the show here for today, and it is rolling crashes. Why, Denny? Like somebody's saying, what's crashed? What's crashed? Well, let's go through it. It started last week with the healthcare providers, with UNH, Humana, obviously got trumped with the cap, and you saw these stocks that are typically lower beta names gapping down 20-25%. UNH, CMA, those are UNH, Humana, Elevance Health was another one, ELV, but it bounced back after its earnings. CVS, that's where it started. Then we had the software crash. We had that day where all those stocks were trading down. We know ServiceNow we were talking about. Microsoft was not good. CRM, Workday, you go all the way through. Then you had the silver commodities crash. We know silver, flying. Everybody has to own it. And then bang, we get one day, it falls 30%, 29% in a day. Incredible falls. Then on Friday was the gaming stocks. So you get, and again, we should give ourselves some credit here, because I was saying I think there's that potential for some of these gaming stocks to get disrupted as well. We've been talking about software, we've been talking about AI, and potential, I was saying, is that stocks like Unity, like Take-Two, could be disrupted, because who knows what AI can create. The very next day, Google comes out with Project Genie, video gaming stuff, Unity. Boom, down 28% on Friday. Take-Two, a stock specifically I mentioned, I would not want to own it. Down another 15%, did bounce off those lows. These are crazy disruptions happening here in the market. And then over the weekend, we get the crypto crash. Bitcoin down another 6-7%, which is something we've been talking about here too, saying it's hung out the lows for too long. IBIT was just down here for too long. So if you look at the IBIT chart, same thing. Now we're breaking down. Ethereum, same thing, breaking down. So you're looking here and you're thinking, and then natural gas too. Jay Rice, great point today as well.
Yeah.
UNG, flying. It's so cold. It's going to go up, natural gas. And then bang, there's a rug pull. Boom. Rug pull happens. UNG, what goes up seems to must come down. This is the market we're in here right now. The S&Ps are not telling the tale of the market. The tale of the market is there is a lot of stocks just holding on very well. Hence the S&P, mega cap 7s held up pretty well. Not been a lot of damage. But there is rolling pockets of destruction happening. Palantir, a retail darling, is now 140. It's bouncing. It's 149. 146 from 200 to 146. There's so many stocks that are 25, 30, 40% off the highs. At the S&P set like 1% the high. La. I mean, obviously S&P, fantastic investment vehicle, but I want to get your thoughts here, Joel. I mean, I just wait for the next sector. What's getting harpooned tomorrow? Try to predict it. Like eventually memory. I tweeted last night. Memory is going to fall 25% in a day, prices, and these stocks are probably going to go down. When that happens, I don't know, but it's on deck. I mean, you can't just have stocks going up this much. We've seen what happened with silver. I think memory could do the same thing. Now, the SanDisk earnings were phenomenal, but memory prices in itself, I think eventually are going to have that kind of a pullback here too. So interesting. This is a market that has little landmines everywhere. It's a tricky market to navigate.
But it just seems to navigate it, just as you said. I mean, we had.
Well, no, it doesn't. So I want to interrupt you. The S&P, with the S&P blinders on, the S&P navigates it. But it is very hard. If you ask individuals, how many people, are 1% off their all-time highs? I hit all-time highs on Tuesday on my long-term account. I lost like 4% the last few days because I've got some Bitcoin. I have, some of these other stocks that just got dinged with the rolling crashes. The rolling crashes are for real, and they're hitting a lot more people. Now, the S&P very diversified, but the S&P is also Mag 7. It hasn't come really for Mag 7 here yet either. I mean, Amazon is sitting up here, hasn't sold off whatsoever. Microsoft has. Meta, though, Meta has helped Microsoft that day, and Meta's up. So, I mean, you're just going through. Apple's held up fairly well on the earnings. The S&P is Mag 7. It hasn't come for that yet. If it comes for that, then the S&P will feel it. So I'm just saying the setup here, there's a lot of risk in this market right now.
And let's just look at look at the IWM too, just to get a better perspective on the market. I mean, that's pulled back, but that looks like a healthy pullback, right? You went from 270 to 260. You traded down a little bit. The triple Qs here still. I mean, if you're nervous about the market overall, I mean, still you got to look at it and where it's trading to its relative highs, and even I mean the buy the dip mentality is just out there. I mean, look at the price action that you had from last night. So it's like, okay, we'll take our money here, but we're going to put it here. And until you get that sell everything mentality, then you're just going to see this, choppy up and down, market. As long as we go choppy up and down and we stay up here, I think everyone's pretty happy. It's when you get into that sell all mentality, which we haven't seen in a long time, is when, people start to get spooked. I think with your silver and gold, what you saw after that day on Friday, some people that don't look at the markets as often as we do, right? Look at their statements, look what happened over the weekend, and like, I'm done. You know what? I had so much profits in it. I don't know about margin calls. There was a lot of rumors that there was, some big banks and, some bad trades going awry there. But it's so hard to sell when stuff is going straight up. But you know what? It's even harder to sell when it's going straight down. And catching the momentum.
And that's it. But even though let's just stop and like, say the theory. The buy the dip mentality is still there, but not on anything that rolling crashed. So the healthcare providers, I want to go back to this theory because I'm putting holes in your theory because, again, S&P centric and it hasn't came from Mag 7 here yet. UNH hasn't bounced at all. It's still down here at the lows. Hell, Humana got downgraded today at the lows. We got Morgan Stanley downgraded underweight. They're like, it just fell 70 points and now Morgan Stanley says sell. So that hasn't bounced. That was the first rolling crash. Software has not bounced at all. No bounce in software. You can go through them all. ServiceNow. Microsoft, no, not really. Microsoft sitting right at the lows. CRM, not at all. So that hasn't bounced. Silver, everybody was buying the dip on silver on Friday. It didn't bounce. It went down more. So that didn't bounce. Commodity trade, the gaming stocks didn't bounce. Now we're at crypto, UNG. Is it going to bounce? So we can say there's buy the dip mentality out there. And there is in the S&P. But the stuff that's getting hit with the rolling crashes has not bounced yet. That's concerning. So I just think if it keeps spreading, if it hits, and this is a big if, I'm not calling for the end of the world here, but if it hits the Mag 7, all of a sudden be like everybody, all the media will be like, whoa, what happened? Whoa, what happened? Well, we're set up. It's rolling through. So it may eventually come for the S&P, and then the indices are going to feel it. The indices haven't felt it because it hasn't come for the S&P yet. That's the only reason that the S&P and the Qs are holding up like they are. And the IWM has 2,000 companies, so it's diversified. So I don't know when it stops, but all I know is every single day we come in and there's a major sector down 15 to 20%. It's not a stock. We always see stocks down 15 to 20%. It's been a sector that has been down 15 to 20%. That's a huge difference because you're hitting a pocket of stocks, a pocket of stocks, a pocket of stocks. The memory bubble is for real. I mean, memory is not going to continue to go up forever. There are people just chasing and chasing and chasing. And at a certain point in time, you're going to see that on deck. Like, I think it's on deck. I'm trying to predict the next one. So
yeah, not to mention Rocket too on Friday. That got decimated.
Yeah. So we have out of the blue, PFSI, PennyMac Financial Services. Bring this one up. This is a stock that typically moves $1 a day. It moves $1. In the entire last year, PFSI ran up, that big move. But we're talking years and years with this stock trades in a range, daily range $1, just kind of grinds itself out. Mortgage company all of a sudden comes out with guidance, and the guidance wasn't good. And the stock falls 30% in one day. Nobody has that on their, like, the expected move on that was probably $5. It goes down 50. And then it drags RKT and UWMC, so that's where I got really dinged on Friday, into the mud. I mean, because, oh my God, they're mortgage companies too. What are they going to say? They didn't even say anything, and Rocket was down 20% or 15%. So there you go. Another whole sector hit again. I mean, it's incredible, the carnage in pockets of this market. Pockets of this market are really getting hammered, but the S&P just keeps la because it hasn't come from Mag 7 yet.
And what are you using? I mean, your Berkshire, that got hit. That's recently off its low. Like, what's your key? Like, when is it, what is stocks or what's that? I mean, Burke got hit too, but that's starting to come a little back. What are you using for keys to say, it's done. We're done. We're done value. We're done with growth.
I don't know. But also overnight, we've seen where it seems like overnight we're showing weakness instead of strength here now. We're seeing things change. And if you're not reading the tea leaves here, you're not paying attention because there's a lot of people who are thinking, what can I buy? I got to buy. This market's going to go so much higher. And maybe it is. Maybe if it doesn't come from the Mag 7, the market will continue to go higher because the market S&P is Mag 7. So if it doesn't come for that. But there is so much carnage under the hood here. Tesla's down another 9 points here today. I mean, look at oil. So this brings us to our first macro headline here. Oil's been running, and then bang, goes right back down 5% today. So it's a market full of landmines. And right now, if you're diversified, it seems like, every other day you're getting hit with a landmine. Now, if you're on 3 stocks, you might get lucky and navigate it. But if you're diversified, there's an odd thing that's landmining you, it seems like, every day, which sucks. So there's risk in this market. A lot of risk. And stocks are not cheap, folks. And geopolitical risk is real. So we can say the market has been shrugging off all of these risks for a very long time. And why doesn't the government shut down? That happens too. We can tie that one in there too. But overall, the market is hitting things now, which it wasn't doing before. It wasn't hitting sectors. That's 6 days in a row, 5 or 6 days in a row. We've had a major sector down 15 to 20% every day. Like small sectors, mortgages, silver and precious metals one day. But software is not small. Software was real.
Yeah. So let's direct attention to Gabe Fabe's good point here. So what's the play here given the rolling crash theme? Shorting, fading, buy the dip?
I think if you're an investor, it's playing it cautious here. So I want to talk with the investing hat first. It's playing it cautious because you don't want to be margined up in this market right now. There are people who are just flying, chasing stuff. It's paid to chase Micron and SanDisk all year, but at a certain point in time, it's not going to. I mean, SanDisk in itself had what we said, Brentster, the best quarter that me and you've been on the news desk at Benzinger, we were over there for 10 years. I've been trading stocks for 25 years professionally, 27 now. Years are flying by. I don't think I've ever seen a stock blow it away like SanDisk blew it away. Like it may have been the best quarter that I've ever seen from a company. And the stock gave it all back. Is that a bull market? The stock gave it all back. The stock was up 140 points and gave it all back. So you could say, wow, SanDisk is great. Look at SanDisk. That stock, where did it hit after hours that day, Joel? 6?
I think it even went higher in the regular session, but what did we? No, it didn't. It didn't. Pre-market high was about 680.
680. Now it's 583. After reporting the best quarter in the history, it has a 150-point gap up and gives it all back. You know what? One thing, so if you want to know how to trade this market, what is working the best right now is sell the rip. When they're selling rips on the stock that reported the best quarter ever, it's sell the rip, which brings us to Disney. Disney comes out. They got to buy it because it's a good quarter. Let's buy it. Brentster, give us the earnings.
Disney
I know I'm going a bit off script, but this is a theme here, folks. I'm trying to pound something into your guys' heads right now.
I like it, Triple D. So Disney reporting Q1 earnings $1.63, a beat versus $1.57. Modest beat, nothing like super exciting. Sales also beating about 26 billion. Analysts were down around 25.7 billion. The guidance, they're expecting earnings this year to grow in the double-digit range on a year-over-year basis, plus 10%. I mean, this report is fine. This report's fine.
The report was good. The double-digit stuff, the report was good. In a normal market, the stock's up $7 or $8. And you know what? The algos think we're in a normal market still because they're stupid and they don't adjust fast enough. It's not AI trading, it's algorithmic. And they're like, beat, buy. Beat, buy. They buy the stock up to where they go, Joel.
Over
instantaneously.
118.
Let's buy it up. We're taking it right up. This is a great report, Disney. Let's go. Let's go. LFG. Let's go. That's what the algos say. Boom. They buy it. And then crickets. Oh, there's nobody else buying. Why is nobody else buying? Wait. Now look down there. Why is nobody buying down there? What do you mean? It's a good quarter. Hey, buyers, come on up. I just bought a 118. Take it to 120. No follow through. So what happens? Leak. We're down. It's not rocket science right now. They are selling the rip. The algos are ripping them because they're stupid. But smart traders are coming in here and saying, we got bears in control on almost all stocks right now. Even on the ones that are blowing it away like SanDisk, they're giving it back. Sell the rip is working, folks. Short the rip is working right now. That's what's working right now. So these rips are getting sold, and then we're getting pockets of destruction happening here too. Bears, despite the S&P being 1% off the highs, bears are in firm control in this market right now. This is reading the signs. Good earnings report. SanDisk, give it back. Great earnings. Good earnings report. Disney, give it back. 110. Are they coming back in to buy it back up to 118 today? I don't think so. Do you think, Joel? You just went red.
It's been in a trading range from 108.5 to 116 for better part of almost 3 months. So I'm just looking at that's just a messy looking chart too. I mean, that is just, up and down and all around. So use the parameters. It's been there since, you cleared it in November. You cleared that 108.5, but still in a trading range here for the House of Mouse.
Okay. So there is some good news. So now I'm giving you bad news. The good news is Trump launches. What is this rare earth headline here, Brentster? Trump
Yeah.
launches
All right,
$12
I
billion.
gotcha.
Tell me about this one. Yeah.
Yep, that was it. Trump launches $12 billion minerals stockpile to counter China. There was a report from Bloomberg this morning, right at 7 a.m., just after 7 a.m. actually. It seemed like the rare earth stocks started moving first. USAR, MP, lithium was also moving, and then uranium, like a UUUU or a UEC. Those started moving right away, right after we heard about this report. I'm going to put the report on screen just for a second, then we can take a look at some of the charts here with Joel.
So these stocks got harpooned by that report last week that the administration wasn't going to put the pricing floors in.
Oh yeah.
And then MP, and we saw MP, USAR, UAMY rolling crash. I didn't even mention that sector. The whole rare earth stocks were all down 10% plus. Now they get a lift back on this headline that Trump's going to launch $12 billion mineral. And this is a good headline, and the stocks should be up on this. But what are we in? We are in the sell the rep market here. And we are starting to already leak on MP materials. Where did MP get to here, Joel? We're already starting to leak a bit.
Just got over $62. You got to 62.30, and I'm looking at the range. You're not even at the high from yesterday at 63.64. So keep an eye on that. The close is way down at 58.77. But yeah, make sure you get follow if you're buying this off the hop. Make sure you get follow through the pre-market high. You got a persistent seller here at 62. But like the other thing too, like if you're like bringing these charts up, like we just talked about the Disney, and we just bringing up MP, totally unrelated. They're not looking like the charts that we saw earlier in the year when the market was just going straight up. You're seeing cracks forming. You're seeing stocks go from 100 to 50, and then they're trying to get back half of the move, and people are like, "No, I'm not waiting for the 50% retracement.
Yeah.
I'm loading. I'm getting out at 70." Now you have another break, and this is just hypothetical here. What if you eventually break this 50 level and go to 40? Then you're creating a whole nother group of bag holders. So then the next rebound up maybe only comes up to 60. So you can see how much the sellers readjusted their expectations after seeing it go from 100 to 50 in just a couple weeks. 20-point bounce are out there. You can see that forming in a lot of stocks. And then, yeah, the support. Well, if I had to tell you where great support is in this, I'd tell you $50. That's a long ways down.
Money Mitch is right in the chat, and this is what we've been talking about on STN and on this show for a while here. It's been 3 months. That value has been outperforming growth. That value has come back. And again, don't look at Berkshire Hathaway for a value because that's got the Greg Abel and Warren Buffett hangover happening. But, growth is turning to that downside here, Money Mitch, and you're correct. I mean, this is where everybody's been hiding is growth, growth, growth. It was great from April to October. But we have seen most of these stocks that have the high nosebleed PEs traded at their highs back in October, and they've been leaking ever since. And now just quietly, a lot of these names are 20, 30, 40% off the highs. Some of them reignited. ASTS, Rocket Labs, reignited in 2026. They blasted off. A couple puns there for you. But the last couple days starting to show weakness here again. Maybe it's a SpaceX coming, and we see SATS trade down, Tesla trading down, on reports that they were left out of the reports on the possible SpaceX merger here this morning. But, ASTS, we look at that one, had an ugly kind of candle on Friday, now holding up well, but we've run a long ways. These are where I'd be taking profits here right now. Rocket Labs, already starting to show some weakness here. I think it's just not this market where let's buy these nosebleed PE names because we know they're coming back to the highs. Feels a little bit like 2022, where a lot of these names were just way overdone, and it's time for, the reckoning. And we're seeing pockets of that happen continuously. People who were trading silver, punished severely. People who were chasing the software names 3 months ago, punished severely. People who were chasing, the commodity run-up, punished. People who've been holding on crypto, punished. So I mean, there's natural gas. People who are chasing natural gas on the weekend punished. People who chase the SanDisk earnings. You can say it's still up, but yeah, I know it's up 100% for the year, but it's still down 100 points from where it traded on Friday. So chasing not working here now. Sell the ripos.
All right.
Robinhood, fantastic one. No rest days. Look at Robinhood. Look at this chart. Nosebleed peony. The stock topped out same thing back in October. Look where we are now. It's 35% off the highs. These are not signs you see in a bull market. These are signs you see in bear markets. The only thing that's in a bull market is value stocks. That's where, it's come back. Some of the small caps, some of the stuff that was left for dead. And maybe that stuff, takes over. But we've seen the market, it struggles to really gain traction when you're leaning on low PE names to do it. So in order for this market to really turn around and really start ramping up and going, like continuing to go higher, you're going to need those growth names to start turning it around. Maybe they do. Maybe the party continues. Maybe Trump comes in and says buy stocks and ignites everything. But there's a lot of risk in this market right now, folks.
Well, do we want to cover some of those former darlings? NVIDIA. Look at the chart on NVIDIA. I mean,
it's
just
held up well. But
yep.
AMD kind of came for AMD a little bit on Friday, starting to leak here a little bit. But these have held up fairly well. They haven't come for the chip names yet. Do they come for it? That's the question. What are the technicals saying? Like, does this look like a chart? Normally, you'd say this is a dip to buy. Maybe it is. But I'm spooked. I'm spooked a bit.
It's down on the NVIDIA is down on a report about the OpenAI investment has stalled, and that was Jensen Huang he refuted it. I mean, is it a dip to buy? I don't know. It's been in a trading range here for the longest time. It just seems like there's just a consistent seller here over 190. All these tops here going back to late December. I mean, if this establishes a strong 190 bid, I think it's a different story. But right now, you've seen very consistent selling. In fact, all those days that it popped over one night, this was actually the CES day right here. When it got that pop, it got near there on Friday. So it's showing some strength pulling back. That chart doesn't look too bad. I'd just like to see like a base of support here that you had at like the 185 area. See if sellers are willing to, to step up to 190 to buy. We're currently trading down 288 here, NVIDIA. Another stock, let's just talk about another one that has a fall from grace. It's trying to recover. Oracle.
It's a big pop here overnight, but every time Oracle pops 5, 6, 7%, it just gives it back the next day. I would say again, guilty until proven innocent. Something else happening here. We know software names have been hit, but there's lots of other things to think about. I don't know. Oracle's been a really tough name. I've got this one wrong. I bought it obviously, and then I sold half of it around 205 because I was like, I'm just, don't know what's happening here. Now it's 170, and I'm like, why didn't I sell it all? Got in the long-term account. I mean, it's given back the entire AI move. You're now into like coming back into like where we were 2 years ago before we were even thinking of this as an AI company. But they're worried about the debt. They're worried about a lot of things here taking on. They're worried about the spend. Same reason Meta was punished for severely earlier in the year, or earlier last year when the AI spend, or later last year when the AI spend was going too high. I mean, that's what they're worried about here. The Oracle's spending too much money. So I don't know. You get a nice 7-point pop in this, but I'm going to say guilty until proven innocent.
If trying to get back to fill the gap at 170, 186, it got considerably over that, trading up to 175, 76. But see what happens. See if it can rebound, get back, fill that gap. 180 looks as major resistance here in Oracle. Our guest Tim Quast here should be joining us momentarily here on pre-market prep to talk some market structure. Should we do we have time to cover Tesla before Mr. Quast comes in here?
Well, and here's, and again, Tesla, I have it in my long-term account. It's a small position here, but I've been saying for a while, I just don't like the chart anymore. I mean, I don't like, that it's been leaking. I don't like, that Musk is so one-sided on his politics because he's cutting off a lot of his customers. And the bloody fundamentals for the car company itself are terrible. The sales just continue to drop. So it is all on story. And I'm still in there because I believe in the story. I believe Optimus could be awesome, but then I look and part of me just says, I just want to get the hell out of this thing because the valuation is nuts and the fundamentals are deteriorating here. I don't know what Musk might say next. The biggest risk always to the Tesla thesis is what Musk might say next. We don't know. But SpaceX, so let's get into this report here because there was rumors on Friday that maybe Tesla and SpaceX were going to merge. It doesn't sound like that's the case, at least not from this article.
The first report last week was from Reuters. Reuters saying that SpaceX and XAI could merge ahead of an IPO. This kind of made sense. Shortly after, like 12 hours, maybe 10 hours after, Bloomberg came out with a report and added Tesla in there. SpaceX, XAI, and Tesla could merge. Tesla started responding to it. Now here this morning, you can see it in the Tesla chart when this Bloomberg report this morning came out. Bloomberg with this report here, I'm showing it by investing because I couldn't find it on Bloomberg, but SpaceX may announce XAI merger as soon as this week. Tesla not mentioned at all. So I think because of that, Tesla shares started selling off here this morning on this report. The reporting last week was, if you ask me, a little fishy. I thought it was odd that two very big publications, very important publications, had very similar stories. One had no implication for a stock right now, Tesla, and then shortly after, a Bloomberg report came out, another publication report came out and added Tesla in there. And then we have the same report without Tesla. It all makes me think that there was a little manipulation happening behind the scenes. And, we know that happens every once in a while, but just a little heads up here on Tesla price action this morning.
Yeah, right. So lots of headlines going to be happening. We know SpaceX is going to be the biggest, IPO of the year if they actually get it done. Are they going to merge something or do something before that? It's possible. I think consolidation, for Musk would be nice that he can have less companies out there because, I am concerned that he keeps spreading himself out so much. But, overall, right now, if you want to, in the public markets, the only way to play Elon Musk is through Tesla. I wonder when SpaceX comes public if that doesn't actually put pressure on Tesla shares. So I think there's a few reasons to be concerned as a Tesla shareholder right now. Here we go. Let's go get our special guest, Tim, in the background.
Well, guys,
Joel is on mute.
I have no idea.
Tim will break the awkward silence. Tim will break the awkward. Hi, Tim. How are you, buddy?
I am well, thank you. How about you guys? Good to see your faces, Joel, Dennis, and I did see Brent, but now Brent's gone. I don't know. Brent has vanished.
Hey, Tim.
There he comes. Okay,
good morning.
There. Good morning. So,
Tim, we've been having this discussion, and I really need you here today because we're at the crossroads for the S&P. And what we've been talking about, laying out the case, it seems like we call this show rolling crashes. In the last 6 days, we have seen not a stock, but a sector get hammered every single day. It started with healthcare providers, then it moved on to software, then it moved on into commodities and silver. We know the silver bubble burst and went down 29%. Friday was a little bit of the gaming stocks. Today we see crypto and natural gas getting hammered. It's like, but the S&Ps sit up here because it's Mag 7 and hasn't come for that yet and act like nothing is going on. I want you to look under the hood just to see what you see happening here with market structure edge, because sometimes, maybe I'm being, selective perception. Maybe it's not a big deal that Humana falls 25% a day. Maybe it's not a big deal that silver falls 29%. It's not a big deal to the S&P. But is it a big deal overall? That's my question to you. How are you feeling about this market?
Well, so the use of look under the hood reminds me of the humorist Dave Barry. I'm old, So you guys might be too young to remember. Well, Joel, you might know. But anyway, so Dave Barry was this, this humorist, wrote a bunch of books, wrote a column for many years for the Miami Herald, I think it was. So, but anyway, he would say, if you're driving along in your car and you hear a knocking noise in your car, what do? And he said, turn the radio up. And so it's kind of like that, right? So do we, as investors, do you just turn the radio up to drown out the knocking that you hear, or is it something that should concern us? And I would say, so it's in my nature, but I think this goes back to October 10. The problem with the U.S. equity market is it's so enormous, whatever it is now, $75 trillion of market cap, something in that range. And so a little thing happens and no one really pays attention, and the cycles are very long. It's difficult at times as investors to understand where we are in the cycle of things. Are we off to boom times again, or something developing? And my thesis has been that October 10, which is when Bitcoin crashed first. I mean, it's down like 12-14% in the last 5 days again. And we had really the volatility of volatility in SPY was the 6th largest since July of 2017. It was a very big event. And I think it is the knock. They're all little things, little oddities that one should be aware of. And then the question is, what do you do about it? Well, I do think, one of my favorite phrases is that, the prudent foresee evil and hide themselves. If you see that something seems to not be correct, then probably you should be careful. And to me, again, you can go look at the demand supply balances and get a pretty good idea. But I think the reason that these things are happening in such shocking fashion is the market's overdependency on derivatives. Friday was a month-end options reset date.
Yeah.
If you're going to rebalance your positions, oftentimes big institutions do it then. The problem is there is a counterparty who will have hedged. And so let's say you were, as our market strategist Brian Wilson wrote on Friday, so suppose you want silver to be 3% of your portfolio, and now all of a sudden it's 5 or 6%, and you're at the end of the month and you can reset your derivatives positions, and so you decide to rebalance, and the ripple effect, because the counterparty, let's say Goldman Sachs on the other side of the trade, has used derivatives to hedge their exposure. Well, all of a sudden the derivative element gets written to zero. And so all that implied demand in silver goes away and it drops 30%. These are the kind of risks that exist everywhere in the market. It's why a stock like KLA, which is a corporate customer of ours at our corporate business, could drop 15%. If you're reporting earnings right when options expire, there is a risk that all the hedging could be marked to zero, and there goes 15% of your market cap. And as traders and investors, you have to be aware that risk exists. There is a logical explanation for it that fits with how the market works, but it's not fundamental and it's not technical. It is really mathematical.
I love this conversation because I am very concerned not only with the options, but with the levered products. We now have single stocks across the board where they lever them up 2 times, 3 times, and 3 times per. It's just like leverage everywhere, leverage on leverage here. This is like the whole reason that, like in the mortgage markets back in 2000, this is why the financial crisis started. Now, again, Are we doing the same thing with stocks? Where everybody's like, oh, I do the double log or the triple log. And they were trying to get 5 times approved, but the SEC smartly, regulators, if you're listening, smartly, didn't approve the 5 times one because the stock falls 20%. Those go to zero. Are we simply leveraging up and derivatives coming out left, right, center, derivatives that we can't even think of sometimes coming out? Is this an issue?
Well, I think it is. And looking from the perspective of how public companies think about the market. Certainly it is, as a long, 30 years in the investor relations profession, which is the liaison at public companies to Wall Street. there's certainly a belief that the interests of public companies have been marginalized in the interest of things everybody can trade. I mean, we have turned turned the market into a prediction market. And what happens is that there are a lot of binary bets, and all these leveraged instruments permit it. I mean, 60% of the S&P 500's volume now ties to 0 days to expiration options. And so then the market becomes a gamma delta hedging exercise that sprints into the finish. And you get big moves in the morning in the opening auctions that kind of moved to a different price level during the day, and then another one at the end of the day. And a lot of that is a product of gamma and delta hedging. Now, is that a good thing? Not for public companies. A public company would say, well, I'm using the equity market to raise capital, and yet that's not the participation that's occurring there. That doesn't help us, I realize, investors and traders, and we'll get to specifics. But no, I think it's at some point it breaks. And I'm not bearish, but I think about those things all the time. We can see it occurring in the data.
I like your analogy with the knock, knock, knock. And that's where I'm at too, is my car's knocking right now. And I don't want to turn the radio up. I want to just maybe get a little bit more cash, a little bit more, just in case. I don't feel like it's the time right now to go all in on this market. I feel like there's too many tells, too much knocking. That's making me feel cautious too. So I'm being very cautious. Even in my overnight trading, which sometimes, I margin out, and I'm getting, the weekend trades we're doing. I'm just buying everything because it just goes up Sunday night anyways. That's not working last 3 weekends in a row. We're seeing tells that the shift is changing a bit. And that knocking analogy is perfect because we're not, right now, most people are sitting up there. We're feeling pretty good. S&Ps are at the highs. Qs are at the highs. Donald Trump saying market's making new all-time highs. The general public thinks the stock market's doing very well. But as traders here, we're seeing little things that are concerning here. So I like your idea about going cautious. If you were trying to hedge this market, what's the best way to do it? Just buy some of these inverse longs, or is it, to sell stocks? What do you think?
Yeah, well, and I will say this in measured fashion because it's data, not advice. I'm long volatility because volatility is up 30% in the last less than a month. Because when knocking occurs, you can look for mispricings. And what creates volatility? Well, changing prices do. The definition of volatility is really price change. The more frequent and the more extreme, the more volatility you get. So that's something one could do. I'm not, you have to be careful with instruments like UVIX. It is a levered, it's the stuff we're decrying, but there are useful periods in time for those things. So I think about that, and that at inflection points, there are demand supply cycles, and they run mathematically about 11 days. They have over the last year. That is, you hit a top in demand, and you have a period where you have an opportunity to play volatility. When it bottoms, you should stop. Those are things one can do. And there are parts of the market where money is still going, certainly. But let me show you this. I want to share something really quick here.
Please.
It's an internal view that we use. Give me 1 second here. But it's kind of interesting. So it's an odd chart, but what it's showing is the tech sector. It's the tech sector over the trailing 20 trading days, and we measure performance relative to midpoint. And so you can get a pretty good idea of buying and selling this way. And what's interesting is over the trailing 20 days, there have only been 1, 2, 3, 4 net buying days. And then under that are the patterns of behavior. Traders and investors, the market doesn't have a single behavior. It has different purposes and time horizons. Some of them are very short, some of them are long. And those patterns come and go in measurable fashion. But I would look at this and say, right around, this is January options expirations. And you look at this and say, it's everything. It's indexes and ETFs. It's hedge funds. It's long only money. The only thing that was not in there was Citadel, Susquehanna, and Jane Street. The orange bars were out. And all this money was principally a seller into January 20, new options traded, and the 16th, the old ones expired. And so there's more going on. But we look at this and go, we circulated this internally because it's very unusual to have all four behaviors on the same side of the zero axis. And all it's telling us is stuff increases and causes prices to change, and then it goes away out of the market. And so the stuff that increases is what causes this. And you'd look at it and say you'd have no idea that's kind of bad. It's not good. I would look at that and say there's still a possibility of more volatility. Now, we're 8 days into an 11-day cycle. Here's what I mean by that. These cycles are short, but if you were looking at broad market sentiment, what we do is measure, it's an algorithm, 10-point scale, we normalize to 10 points, compared to SPY as a proxy for the S&P 500, supply, reg SHO, short volume data, our proprietary treatment. But here's what I mean. The market topped on, call it January 20th. And so then like 1, 2, 3, 4, 5, 6, 7, we're 8 days into the cycle back to mean reversion. So if we stuck to the norm, we have 3 days left, and then the cycle continues. However, if something's going to break, these are the points where it happens, where you have converging demand and supply. Diverging demand and supply are what create these big runs. Boom, right? You have rising demand, falling supply, and the consequence of that is rising prices. We have falling demand and rising supply. The consequence of that can be pressure. Now, it's not statistically not very much, but I look at all that stuff. It's to me, if you are a tactical trader or a long-term investor, and I'm both, you have to think about these short cycles because they can be very traumatic. Look at what happens at options expirations. Here's options expirations in November. Clocked. We got absolutely shellacked. Options expirations in December. Brief, sharp, right? Options expirations in January, right between the two, because VIX expirations were in the next week, whacked again. That's context. You have to think about those things as events. And if you know about it, then you can say, whoa, I might play some volatility trades around those.
Yeah.
It's difficult to be long or short, but you can play volatility.
How about your trading idea for the week, Tim?
I did this for CNBC and Schwab, and I still think, if you look at the demand supply chart for SanDisk, it's still awesome. I mean, it survived that the throttling that some chip
amazingly
stocks took. Right. And you can see, look how strong the demand is. It's been at 10 since December 30. On the supply side, sharply falling. It's all the way down to 36%. The whole market is 52% short, by the way. Right? It's very much like Citadel is. It's about how they run.
Yeah.
So this is the kind of combination that gets you a really nice move. The contrast might be, well, let's look at Tesla, right? You were talking about Tesla. Brent, you were talking about Tesla. Let's have a look. What's the demand supply difference between Tesla and SanDisk? Well, would I own this? No. I mean, the demand's fine. It's at 5, but look at the supply side. If supply is rising and demand is flat, that's a convergence. And look, it might do fine, but I'd sure rather have SanDisk. Right? That's the thing you want to look at. If you look,
how do you know when to ring the register on SanDisk? Going back to that, because we've been 10 for a long time. Is it wait till it ticks down, like on your system, like wait till it has the tick, and then say, okay, now get out? Like, do you just ride it until it goes to a 9? You
could. I would look at this and say, when the supply side rises, I would leave. It doesn't mean it's over. But if you can never get the timing perfectly. You just need a good reason for an entry and an exit. And I would, if this came down, yes. If this goes up, yes. It's kind of like going to KLAC. You can see this, that, what was the problem for KLAC ahead of earnings? And you can know this. Look, I don't know what something's going to do with earnings. Everybody had bet long coming out of January expirations, but look at the demand supply equation. So you have several days to know, boom, boom, boom. It's rising. Supply is rising, and it's over 50% on January 28th. Right? So, and demand side was coming down. Now it's flat, but it came down from 10. I'm not hanging around for that. You don't know what it's going to do, but the probability is it's more likely to do poorly than well in that situation. And that's a good reason to leave. By the way, you can get our daily notes for free. Just go sign up for our daily notes, and you can learn how to use market structure. And it's an easy way to start making that part of your thinking.
Tim?
Okay, did I answer your question, Joel? I'd say
yes, sir.
I'd say
yes, sir. Tim Quast, Market Structure Edge, founder, CEO, joining us on Pre-Market Prep. Tim, we want more of your content. We'll be talking to you soon.
Sounds good. I'm off to Belize. I'm going to go sailing Thursday, and I'll be back.
Holy,
the 15th.
your lifestyle!
When are you coming back?
I'm coming back on the 15th, just in time to report back from the sea. So keep a hand on the rudder while I'm out, would you?
I guess I'll be talking to you at the end of February. Thank you,
My next
Tim.
life, I'm
Have
coming
fun,
back
Tim.
as Tim Quast. This guy knows how to live life here. I'm up here with 4 feet of snow, just wondering why I live here. And you're going sailing in Belize. I'm like, I've done something very wrong with my life here. No, I enjoy it, but
we know that's
Tim.
not true, Dennis.
Yeah.
Dennis, you're going to have the perfect life.
Tim, appreciate it.
Thanks, guys.
Tim, thank you. Later.
Have a good week. See you
later. All right, let's go to rating the ratings, folks. Rating the ratings is brought to you by The Fly, your source for over 1,000 breaking news articles daily, delivered in real time with custom filters and alerts. Discover their new The Fly Pro platform with AI-powered company analysis, unique KPI charts for deeper insights. Scan the QR code or click the link in the description to learn more. I'll serve you up for the first one here. The first one, and I'm going to show Fly in just a sec. First one here, Humana. Humana downgraded to the equivalent of a sell over at Morgan Stanley. Let's take a look at some of the color here in the Fly platform itself.
Okay. I'm going to give this one a C- right now because this is a full chasing downgrade. I mean, the stock just fell 30%, 25% the last 4 days. And now we tell us to sell. Now they say to sell because the stock they think might go to $174. I mean, holy crap. It's 195. We just watched go from 260. And now we got to sell to save ourselves the last $15.
Yeah.
Is that what we're trying to do? We're going to sell to save ourselves the last $15 after we just lost 70. Oh, sorry, Morgan Stanley. Way late to the party on this one.
The firm citing Humana's 2026 bid strategy and policy risk may slow its margin turnaround. The quote, disappointing Medicare Advantage advance rate notice adds 2027 pressure for Humana and a new policy overhang across Medicare Advantage when the company is disproportionately exposed, according to Morgan Stanley. Again, we're looking inside of the Fly's platform here, reading that color from Morgan Stanley.
I'll just say old support, new resistance.
3 lows. We've taken out. We're back down. Right now, Humana is making fresh new 10-year lows. Is that right? It's making a decade low right now in this bull market of bull markets here. I got it back.
Yep.
I think it's a fresh new, or we're getting close to it, not quite. So how many years? Going back to 8 years. Going back to 2017. 8 to 9 year fresh lows. Holy crap. It's been ugly. I guess you get that little dividend there. You know, you get that little 1.87% dividend. So that cushions this 7-year bear market here for Humana. Yikes.
If you've been waiting to buy this at 186.25 since July of 2017, you just may get that opportunity. Pre-market low, not quite at that area. Pre-market low, 188.01 for Humana. You give it a C-. That's being very, very generous.
I don't like to fail people. I don't like to fail people. So I was like, I was even going to go D-, but then I went C-. That was really nice. Because you know what? I mean, at least, you know, I don't think he's trying to call a bottom here, and I don't think I want to call a bottom on Humana either. But a late to the party. Brentster, we got one more.
Yeah, let's do McDonald's. What about this McDonald's one, Triple D and Joel? Okay. BTIG upgrades McDonald's to buy, sets a $360 price target.
Okay, so I'll give this one a B It's, you know, kind of been in consolidation station, ready to go up McDonald's. But what I got to say is, McDonald's, thank you for listening to Pre-Market Prep 3 years ago, because we told you what to do. I'm like, you need to have, like, you know, like, we need to get these value combos. We now have $5 combos. You get a McDouble, a small fry, and a small drink for $5 in Canadian. It's like $3.50 American. I don't know if you have the $5 meal there, but they have done absolutely something right there to come back with the $5 meal. So applause. We called it. They said, give us a value menu that's cheap, because McDonald's prices are going up way too much. Love the $5 meal, McDonald's. So I'll give you props for that.
Boy, oh boy, this thing's popped over 320. This is a weekly, several times since the end of 2025. So yeah, I don't give this that great of a rating. 321.79 was your high back at the end of September. Use that as a potential target. A lot of times you've seen on Mickey D's, you know, on these ratings, whether it's an upgrade, it goes up, it'll give a little bit back, or a downgrade, it battles back. If you're looking for a gap fill, wow, this thing was 302.45 last week. If you're looking for a gap fill on the daily, the top of yesterday's range is 316 for McDonald's. So it's 9 o'clock. We got a little special segment here. It's a good day to talk Bitcoin here. So we are going to bring Craig Tiveres on after that intro, and Dennis and Brett are going to hop over into the STN room, and we're going to talk.
We're going to listen to this interview. We're going to
You're
be.
going to listen to this interview.
Yeah,
the interview's going into the STN room too. So we got this interview multiple places here. So.
All right, here we go.
All right, Craig Tiveres on the stage, a busy man over with the HIVE Digital, being the CEO of Buzz HPC. Craig, how you doing today?
Uh-oh. Maybe he can't hear us. Can you hear us? He froze. Video camera froze. Okay. We'll move it to the background. We're going to get that figured out. His video camera he's ready. It was ready. It was talking. It was going to talk right there. Bring up the Bitcoin chart here where we get Craig. His video camera froze. Hopefully we're going to get that working here in a second here. He's frozen. I think he's going to be moving here in a second. Oh, well, he's back. Let's try one more time. Don't need the intro. Just bring him in.
Okay. Hi, Craig.
How are you guys?
Can you hear us now?
We got you.
I'm on.
Loud and clear. So as I mentioned, Craig Tiveres, he's the CEO of Buzz HPC. We got some volatility in the crypto market, but we just thought we had some questions for you about HIVE and Bitcoin mining. And there's been a transition going on in your company, which you've been spearheading, from a tier 1 Bitcoin miner to a dual engine data center. You're changing your growth profile. You're changing your capital application. Tell us how it's going.
For sure. So very nice to see everybody. Again, Craig Tiveres, I'm President, CEO of Buzz High Performance Computing. So when we think about our dual engine strategy, it's really a transition from one engine to two, meaning Bitcoin funds the build for our AI HPC opportunities, and AI HPC compounds the value. We're running a dual engine model, which has tier 1 Bitcoin mining plus tier 3 AI HPC data centers. So the company isn't relying on a single cycle for growth. On the capital allocation side, our playbook is to use cash generation from mining to fund the tier 3 upgrades and conversions and GPU cloud expansions, while really staying disciplined on ROIC. Again, that's been something that we've been really focused on. And then this is really our growth flywheel. It's where the operating cycle that we have meets that efficiency to create optionality where the next dollar goes. And we had a record Q2 26 revenue of 87.3 million. And the dual engine essentially turns volatility into optionality. So one side generates cash today, and the other builds durability and digital infrastructure for the next decade.
So you're building up that cash flow in 2025, and you're transitioning it for your AI cloud campuses in Sweden and Canada. Could you give us some updates on that?
Yeah, for sure. Yeah, and you know what? We actually don't view the 25 exahash as just hash power. You could think of it more as build power. So we're converting our 70 megawatt site in Grand Falls, and that's a great site because it's based in Canada, cool climate. It has a gross capacity of 70 megawatts, which means that it'll be a primary target for AI training workloads. And it's currently a crypto mining site, which will be converting to tier 3 within this year. And because the facility already has power, our time to transition and transform the site into an AI data center is minimal. And then we have 2 other sites in Toronto and Boden, which is in Sweden, which are really located as in primary markets for AI edge data centers. And they're sub 10 megawatt sites, but they're great for inference. So because of its location and high quality of fiber, again, they make it primary targets for conversion as well too.
So there's factors going into doubling your growth over the past year, right? How sustainable is the current demand, GPU deployment, and utilization trends?
Yeah, but you know what? First of all, we didn't grow Buzz by chasing hype. We grew it by being fast, really playing our strength on the sovereign side and making it measurable. So there are a few things that really helped drive that step change. First was our credibility and experience. Buzz has been a certified NVIDIA cloud partner for some time now, and we've been operating the market really since 2023 as a standalone HPC business, and then launched the first sovereign AI cloud in Canada. The other thing too is that we're really operating one of the largest GPU clusters for commercial use in Canada. And we've been doing this for several years with experience in the legacy business, operating over 130,000 GPUs globally as part of HIVE. So that then led to us obviously posting record HPC revenue in Q2 up 175% year over year. And just another data point, we ranked number 1 worldwide for network speed in SemiAnalysis Cluster Max 2.0. And then another thing to support that was really that key partnership that we executed with Bell Canada last year, which expands our reach into government and enterprise customers really seeking sovereign AI opportunities. Again, they're just all real differentiators in the market and help support that durability.
Why does HIVE view your tier 1 Bitcoin mining data centers is the backbone for scalable T3 AI infrastructure?
Well, the way to think of that is that Bitcoin mining built the power and fiber highways, and then AI is really the next generation of traffic. So Bitcoin miners were originally builders of the tier 1 digital infrastructure networks, which means you had power, substations, you needed fiber, and you really needed an operational sort of way to optimize your energy consumption. And the hyperscale AI now needs all of that. Right. So again, if you look at our approach, and we are again unique in the market because we actually operate the full stack, where we own and operate the data center, but we also operate the AI GPU clusters, which are the supercomputers inside the data center as well. So we do have a full view of how this all goes together. But practically speaking, like if the tier 1 sites, they're already energized, right? They already have this capacity. Like we already have the fiber, we already have the land, and then more importantly too, and you don't talk about it a lot, but we have that culture of operating 24/7. So operating these facilities around the clock. And that essentially reduces execution risk and then time to revenue when converting to a tier 3 plus data center. So really, we're not starting from dirt. We're starting from energized operating infrastructure.
So you've tried to do this in a very capital efficient approach, right? You don't want to bet, the overspend. You're translating this into tier 1 facilities in your AI campuses. Are you improving speed, returns, and just the overall financial discipline while respecting the greenfield builds?
Yeah, great question. But so in today's market, what I'll say is that retrofit beats greenfield when time is money. And in AI, as you know, it's all about time. So there's speed to cash flow, which means like 9 months versus 3 years if you're, say, doing a greenfield build, right? And from a capital efficiency perspective, like what we're thinking about is really reusing existing power campuses and then selectively upgrading things like cooling, redundancy, in some cases connectivity, but it lowers your all-in capital intensity, right? Because, and you're, from a timing perspective, what you're doing is reducing, again, the permitting entitlement risk compared to starting a project from scratch. But for the long term, we have both brownfield and greenfield projects as, you know, we continue to build our power pipeline into the future for many years and not just the current year. So our current sites, they give us time to market advantages in the next 1 to 2 years, but we'll continue to really expand our power portfolio, like in the case of South America and our entry into Paraguay and other markets where, again, yeah, we're just building that long-term roadmap and then continue to go from tier 1 to tier 3 and use those conversion opportunities. So, you know, to really summarize this, like greenfield is, think of it like a 3-year science project. Conversions are an execution sport, and we figure out how to build that muscle.
Okay, final thing here. Bitcoin under a little bit of pressure here over the last couple of weeks and stuff. How does that fit into all your business plans? I mean, you're obviously buying the Bitcoin, you're transitioning away from it. For people that are looking at Hive Digital and looking at the markets, what's the key component? What in the price of Bitcoin? Or are you guys getting your operations to a point with the transition to Buzz HPC that it's just a feeder for that business?
Yes, absolutely. So one, we've always been really disciplined in terms of our operating efficiencies, running lean, really keeping our overall costs down when you look at our Bitcoin business. So we've gone through a number of changes in markets many times, and we've done really well because we have that lean operational efficiency. So again, this is just another change in market for us. We're always prepared for it. We're always able to recover and go forward nicely. But yeah, as the Bitcoin landscape changes, certainly again, what you'll see is the HPC engine fire up, and then you'll see us driving a lot more revenue on the HPC side into the future.
All right, we've been on the line with Craig Tiveres. He's the CEO at Buzz HPC, giving us some great insight there. Craig, glad we got this done. Really appreciate you coming on, and we'll be dialing you up again soon.
Me too, Joel. Thank you.
Okay, folks, that's a wrap for Pre-Market Prep. Back with you tomorrow.